Hi, it's Paddy Hirsch at Marketplace. So student debt in this country totals about $1.3 trillion. And now we know what happens to the money, right? It goes to pay for college. But what about the loans themselves? Well, there are a couple of different types of lenders. You've got government lenders and you've got private lenders. But none of these lenders actually holds on to the loan for very long. Usually, these loans end up in something called a SLAB, a student loan asset-backed security. Now, a SLAB acts a little bit like a bottle of champagne and a pyramid of glasses like you might see at a wedding. Right, now the bottle first, it's actually filled up with these student loans. How does that happen? Well, the SLAB manager, the asset manager, goes out to a bunch of investors and gets them to lend her a whole bunch of money. She then takes that money, she goes and buys a whole bunch of student loans, which she puts into the bottle. And of course, what this means is that the people now lending to the students are no longer these institutions, they're actually effectively these investors. Now, every month, you're hoping that these students are going to make the interest payments on their loans. And that interest is kind of like fizz that comes out of the top of a bottle when you pop the cork. And the fizz flows down through this pyramid of glasses, filling them up level by level. Now, the investors who lent the asset manager money in order to buy these student loans, in return for that, they get a security. And the security is a bit like a bond in that it pays interest every month. Now, the investors who don't want to take too much risk, they go to the top of the pyramid because they know they're almost certainly going to get an interest payment every month. So the credit rating on that security is high, but the interest rate is comparatively low. All right, investors who want to have more interest, they go to the bottom of the pyramid. So they get more interest, but they get a credit rating that isn't so good. And that's because they're taking risk. And the risk is that some of these students will not make their interest payments. If that happens, there's going to be less fizz coming out of the bottle. It means it's more likely that these glasses on the bottom level won't get filled, which means these investors won't get their payment every month, and that's going to leave them very badly needing a drink.